Stock markets have been given some respite from the European crisis this week. It certainly has allowed markets to float back up towards the top end of the trading range. This comes at a time when volatility of assets has been on the decline, and going to start with the chart of this index. This, known as the VIX, the Volatility Index, shows here the huge spike that we saw in August when the European crisis first broke. And of course you can see this sort of very much heightened level of volatility persisting really until the end of November. But it's been on the decline, and certainly now we're coming back to levels that last seen just prior to that crisis during that time. And this as I say, does allow many of the sort of risk markets to sort of gently increase equities, and indeed and done some of the currencies and the commodities. So the stocks that are moving this week include the banks, which we'll take a look at the moment, and also some of the mining stocks as well, which is helping to drive some of the key numbers at the moment. So if we can just start to look at, first of all, some of the issues that continue to drive Europe. And the first here is the Spanish 10-year yield chart. Again, if we see that sort of huge spike, which in yields, there was some real concerns around the European crisis at the end of November. But we've had, since that time, more pleasing developments. We saw one or two initiatives at the European Central Bank area, which was trying to address some of the banking issues of Europe. But the real worry that has been sort of focusing on investors' minds up until now has been the large amount of debt that needs refinancing both in Spain and Italy for 2012. But we have just heard news that the auctions of Spanish debt in starting out, the hope was that they would raise about 5 billion euros. Indeed, demand was seen for nearly twice that, and the yield that they had to pay on that paper was significantly lower than seen in December. So a good start to this auction process, and I think that if this can continue, then it takes away a very key hurdle at the moment for equities to continue their move forward. Just if we also take a look at the banking sector, because it is the banks that I suspect will increase in value on the back of this bond yield situation. The more that situation eases for the bond auction process, the more that equity values will begin to increase in the banking stocks. I'm highlighting Barclays here, really just to show, for all the noise around banking stocks, this stock is now beginning to do quite well. It's looking like it could just break through the £2 level. There's the added feature here in the UK that whilst our banks are generally perceived to be better capitalised than the European banks, and indeed less exposed to some of those issues in the bond markets, that we've also seen the withdrawal of Royal Bank of Scotland, or significant cutback in their investment banking division with job losses this week. And I think the feeling is that, okay, there's not a lot of investment banking business around, but what is will be shared by fewer players, and Barclays may well be a beneficiary in that space. So certainly that's been the case. If you have to raise money in the banking sector, as Unicredit in Italy has to do, it's a difficult process. There is a big rights issue taking place there at the moment, and you can see that that has been an impact. So if you are tempted into the banking sector and investing or trading it, then clearly the safer haven at the moment remains the UK market. Now, just some of the stocks that up until now have proved to be safe haven are beginning to see the impact of the slowing domestic situation. We've had a profit warning from Tesco's. This came as a surprise. I don't think it was felt that Tesco did particularly well over Christmas anyway. So going into this trading statement, there was some decline in the shares as seen there in that particular period. And when we saw results out from Morrisons supermarkets and also from Sainsbury's, the feeling was that Tesco wouldn't be a winner over Christmas. But I don't think anyone was prepared for the shock of what they said. Yes, they lost out at Christmas, but I think moreover they are looking to invest quite heavily in the business. Investment that the business maybe should have made over the last few years and hasn't. And as a result of that, they're severely curtailed what 2012-13 looks like for forecasts. There could be 10% downgrades there to earnings, and that has caused at least a 10% decline in the stock price. So quite a shock there. And it comes at a time when we have a newish management team. So Terry Lee, he left the group in March of last year. So it's a fragile time for Tesco's. It does lead one to conclude that when you've got a big company like Tesco that is under pressure, where will it turn its attention to retrieve the margin that it's losing? I'm just highlighting Unilever here as a consumer defensive that has been a very good performer and quite a well-backed stock over the course of the last 12 months. We have seen a fairly notable turn down in the stock there and a downgrade this week, and I'm wondering whether some of these consumer defensives have become a little bit expensive and vulnerable to a turn down in sentiment. So that may just be an early stage warning there for a bit of a correction in some of those consumer defensives. Just turning to next week, one of the worst performers in the FTSE 100 was Man Group. Over the course of last year, it dropped by 50% on its stock price, and it's been a poor performer starting out the course of this year. The trading update is due on the 18th of January, so that is a trading update to watch out for. Just finally, a couple of things to keep an eye on. First of all, in the commodities space, I'm keeping an eye on oil. This is the WTI price, just gently nudging again as if it's ready for a breakout. Don't want to see that sort of rise too far at the moment, but the tension in Iran is continuing to put a premium into oil prices at the moment. And finally, we mentioned last week about currencies and how currencies are becoming, I think, something more closely to watch after a relatively benign period. And it looks like it's the turn of sterling to come under some pressure. Sterling has sort of just penetrated an 18-month support level at the 153, 154 level. It's trying to cling on as we speak, but nevertheless you can see that sterling versus the dollar at the moment, and I think it's more a rush to the dollar necessarily rather than sterling weakness, but it looks like it may be pushing towards new lower levels and give us a new basis on which to reflect some of those exporters in the UK, as this could be quite attractive for them.